Yep, we're live. And how you doing, friends? A little discombobulated. I wanted my iPad to work today, and it is not doing it for me. I must be missing something through OBS. Oh well, I guess that's the way it goes. All right, it is Monday, September 20th. And today is another Zero DTE day, and today is the 38th episode of the Zero DTE podcast. Today I'm going to talk about volatility and what it really means to our strategy, or what it means to just about any trading strategy, particularly when you're dealing with options. Now, what is volatility? Now, volatility is the measure of how excited or how random or how much energy there is in the market. So generally, we attribute volatility with down markets, and that's because when we have down markets, we tend to have larger ranges in our minute-to-minute moves because people are panicked. So generally, when we have panic, the size of the moves in anything or any kind of decisions are radical. Going from point A to point B is more erratic. When you have that kind of movement, that is also associated with uncertainty. Other things that might cause uncertainty is, well, things that are in the future. Anything that's in the future. And particularly if it's in the future and it appears to be deleterious or bad for you. When something's bad for you, you get panicked and you make erratic moves and you make bad decisions. And that all of that is bad. So for that reason, volatility we associate with fear, because I guess those types of feelings that I just expressed are all associated with fear as well. When you have something that's unknown, that's fearful, we tend to place a higher premium on it because of that unknown. Now that might sound
returning visitor.
That might sound, I guess, backwards or maybe antithetical to what we mean. When we think of, premium or something that's worth more, we think of it in a more positive sense. But what this is really saying is that we're taking more risk. Therefore, it's going to cost us more. So when you take more risk, you're putting more at stake. And so that's why premium grows. Now, options are made up of a number of pricing components, of which volatility is one of them. It's one of the major ones. Also time. Time and volatility are sometimes the same thing, but particularly when you have time associated with erratic movements in the market. And the reason for that is that time, and the further out you go, the further things are unknown. When things are unknown, as I had said earlier, there's a premium associated with that. And we see this in interest rates. So, for instance, longer-term interest rates tend to have higher rates associated with them. And that's because they're more unknown. As we get closer and closer and closer, maybe down from 30 years to 10 years to 5 years to 6 months to 2 months to 1 month to 1 day, that premium or that unknown is lessened, and therefore the premium or the cost of that is less. So that's basically what volatility is. It is this premium that we associate with things that are either unknown or in our I guess our limited understanding, we should be fearful of them. Or concerned. I guess concerned might be a better word, but there are cases where we are definitely fearful. So one thing that we've been experiencing over the past 5 or 6 trading sessions in the S&P is definitely a lot more volatility, and that's happened as the market has been moving down day in, day out, one day after another. And that is cause for concern, particularly when people are used to seeing the market go up, up, up and never look back. And so people are wondering, is this the end? Is this the end of our streak? Are we no longer going to enjoy the fruits of all this free money coming from the Federal Reserve? So the Federal Reserve has been injecting quantitative easing, or injecting cash, or buying bonds and other types of securities in the market at the rate of about $120 billion per month. So that's not what is causing the volatility. On the contrary, that injection or that infusion of cash, or what some people, or what I call hopium for the market, because it tends to elevate the market, well, not tends to, it damn well does elevate the market. That injection of cash is being threatened by a couple of other factors that are happening in the market, and in particular is the continual rise of inflation and whether or not that inflation is going to have sticking power into the future. Now, the reason why that is a cause for being fearful is because if inflation gets too high, then the Federal Reserve is going to have to do something to stem that inflation, because we don't want runaway inflation where prices just start increasing at a rate that we can't absorb, and it will cause systemic problems across every part of our economy. The thing is, there's a double-edged sword going on here. The reason why we're having the inflation is because of the Federal Reserve injecting the money into the market, causing an overabundance of dollars. So the supply of dollars are becoming greater, and when you have an oversupply of something, that causes the value of the dollar to go down. And so things cost more relative to the value of the dollar. And that's causing inflation. So we need more dollars to pay for things. And we don't want this. We can stand a metered increase in the dollar value. And as long as our growth continues at a rate that can sustain that, then we can justify the prices of things for paying more dollars for them. But when the dollar decreases in value so fast that prices rise so quick, then people's incomes can't catch up, and other things can't catch up with it. And so we have a problem. We have an imbalance. We get volatility. And that's what we're experiencing now. There's this fear that inflation is going to go run away. The Federal Reserve has been trying to tell us that it's all transitory, that it is only associated with certain types of inflation on certain types of products or services that are only temporary because of the pandemic. However, this inflation is creeping into things that are not necessarily associated with things that are transitory. So now the Fed is in a tough spot. They're in a tough spot because they want to be looked upon as infallible. They truly do. They want you to believe that they are infallible, that what they're doing is guiding this market, and with great skill and knowledge, and with all their big degrees and big heads that they have, that they're doing the right thing. But in fact, what they are doing, the actual fact, is that they are causing the inflation, and then they are proposing a solution to that inflation. So they are causing the problem and then saying that they have the solution to the problem.
New visitor.
Which by anyone's account is a fool's errand. I mean, you have to be foolish to be able, to believe that the entity that causes a problem is also the entity that we should look towards for the solution. But that's the world we live in. That is the world we live in. So inflation is increasing, and with that, the fear of what that might mean. And what might it mean? Well, what it might mean is if inflation increases, the Fed will then have to reverse what they're doing that causes the inflation. In other words, they would have to stop or at least do something that they call taper the amount of quantitative easing, or the amount of buying that they're doing in the bond market and other markets, to trim that down from the $120 billion a month to something lower. Now, there's another thing that is contributing to this inflation, is that every time that they buy something, they increase their balance sheet, which is now north of $8 trillion. Imagine that. And so true tapering would be a complete stop of the quantitative easing and then the lowering of their balance sheet. But that's not going to happen. There's no way that's going to happen. So they play this word game with us, telling us that they're going to taper, but taper really means just a decrease in the continual buying of assets. So the balance sheet will continue to grow, but it will grow at a slower rate. Now, they'll couch this, or they will paraphrase, or they will put this into words that will make it appear as if they're doing something to address the inflation. And sometimes that's all that's really needed is words. And in fact, that is probably their most powerful tool, is words. And so here we are. We are afraid, or we're becoming panicked, because the Federal Reserve might pull back some of their quantitative easing, which is allowing the market to rise at a steady clip. They are fixing the problem that they caused. And then because of that, that inflation, that volatility is causing the market to pull back some, and people are starting to become fearful. And that volatility, which is a principal component of certain types of assets, particularly options, they become more inflated. The fear component, the value of the future value of a contract becomes more valuable. Now, someone who is an insurer of price levels, or a writer of options, or someone who sells options loves this. We love it, because here at Zero DTE, that's what we do. We sell premium. We collect premium. That is our primary way that we make money with our strategy. We like inflation. We like volatility. We don't like inflation, but we do like volatility. Volatility is our lifeblood. You need a certain amount of volatility in a market just to make it move and to make it worth something. If there were no volatility in a market, if it just went straight up or straight sideways, there would be no more market. It would cease to exist. You need that up and down movement. You need buyers, sellers competing against price. If there's no competition, there's no life, there's no movement. There's no reason to invest $1 into something expecting a higher dollar later on. So volatility is an essential component, and enough volatility will provide enough vitality in the market to make it healthy. Too much, then it becomes anemic, sedentary, dead eventually, when there's no, and too much, basically we have to be in this sort of Goldilocks zone. In the same In the same way that our Earth benefits from being a certain distance from the sun. If it were too close, it would burn up. If it were too far away, it would turn into an ice ball. We are in that Goldilocks zone. So it is with inflation. We're in that zone of not too much, not too little, just right. Now, what does that mean for us as traders? Well, that means that when we have, now, it would be great. Let me just back up here. It would be great if inflation were this sort of steady thing. I'm sorry, I keep on conflating inflation with volatility. It would be great if volatility were this steady thing, but it doesn't work that way. If it were steady, then there would be no volatility. There would be a constant. But volatility comes in huge spurts. It comes in spurts, and then it dwindles away. It comes in another spurt, dwindles away. It comes in another spurt, dwindles away. Sometimes those spurts are relatively benign. Sometimes they're big. Sometimes they're huge. Like when we get a market crash from back in the pandemic crash is a good example. Volatility jumped up to enormous heights, and it took a long time for it to come down. And even as it came down, or the range that we would have in the markets, that started to, slowly decrease. But it was still range, and that range allowed people to buy low, sell high, or sell high, buy low, depending on which side of the market you're coming in on. And then as it got down further and further and further, it got to such a point where it started to become where you could no longer figure out where I could buy into or sell into, because the lines between what appeared to be a range and what was just normal noise became blurred. So now that you know everything about inflation and what it really means to a trader, I'll tell you how that applies to the zero DTE and why a good, healthy amount of volatility is good for us, and a small amount is not good for us. And we have a zone, a Goldilocks zone, that we're well aware of, where things work and then where things don't work. For us, if you were to look at the primary mechanism that measures volatility, and that is the volatility index, the VIX, our Goldilocks zone is very well defined. It is between a VIX of 17 and 34. So when we get below 17, we find it very difficult. Now, it's not like we can just say, there's not some thing that flips or whatever, but it becomes very apparent. When we get to 17 or below, it makes it very difficult to find trades and to put them on and to get enough premium in our trades to make it worth doing the trade. But when we get above there and we start getting into the 20s, mid-20s, upper 20s, even the low 30s, there's this sort of nirvana, of trading nirvana, that's what I like to call it, where it's very easy to put on trades. And in fact, even though it may appear to somebody that we have more uncertainty because of this wide range of things, it actually gives us a higher degree of probability of making profit, because now the premium has expanded. And when premium expands, and the type of trades that we put on are these premium collection trades, things like a butterfly. The butterfly is the best example. A butterfly is composed of 2 short strikes and 2 long strikes. And the long strikes are the 2 short strikes are the same strike, and they provide us with all of our premium because they're short. Anything that is short, or you're selling an option, then that's where you're collecting your premium. And then the 2 long strikes will provide a hedging to those, to hedge the risk. Now, that creates a profit and loss graph structure that looks like a pyramid. And I guess if you're creative enough, you could look at it and say, oh, it looks kind of like a butterfly. But it looks more like a pyramid. Now, imagine a pyramid that is, say, equilateral. It's 60 degrees on every vertices. And it has a certain base width. And then if you were to intersect that with the zero line of where profit is, and you dissect that that pyramid right in half. All right. So now, as it's coming down on its sides, you have a certain width that is intersecting at the zero line, or profit line, and we'll call that level, I don't know, low volatility, the low volatility level. That's maybe 17. Now, what happens when volatility rises? The pyramid itself, relative to the zero line, starts rising. And when the pyramid is rising, its base is rising and coming closer to that zero line, and the distance between where it intersects the zero line starts increasing because it's a triangle and it's moving up, and we're getting closer to the base, which is wider than the apex. That is the effect of volatility on our trades. So if the width of that butterfly where it intersects the zero line of profit represents also the range of prices that we can be profitable under, then as volatility pushes that pyramid up, that range of prices that where we can be profitable starts increasing. Not only does the range of prices increase, but the height from the zero to the apex of the butterfly also increases. That represents the total amount of premium that we can collect. And simultaneously, the risk decreases, and that is the base of the pyramid to the zero line starts getting closer and closer, and so that distance represents the risk. So that is why when we have higher volatility, that means that we have more premium and greater range and an easier time of actually placing our trades, so that we can expect a higher degree of probability that price will end up closer to those short strikes, which is represented by the apex of that pyramid. I hope I drew a good enough picture in your mind. And if I had my iPad working here, I would have drawn a nice, pretty picture. Maybe I'll get that working for next time. But that's the best way that I can describe why volatility is so important to us. Volatility is it's like the tide at a dock. Imagine that a boat, a sailboat, because there you can picture the the triangle with the sails, right? The tide, as it rises, that's volatility. It moves the boat up, right, relative to the dock. The dock level down to the water, it could be your risk, and then as the tide rises, that risk gets less and less and less. It's kind of like the same thing. It is almost like volatility is that tide, and the butterfly strategy is the boat, and it's rising. They say that all ships rise with the tide. So now, hopefully, that was a clean explanation for you. Now, as we stand right now, we put on 2 trades today. We put on one trade after the market had moved down significantly before the market opened, with the expectation that we would find a bottom to this move. And that is all determined by our analysis of the volume profile. There was a huge, huge volume node with a lot of room underneath, where it appeared that that would provide significant support, and it did for a while, but then it broke
New
through.
visitor.
So we were looking to capture that and perhaps move it up, but that wasn't. That was like what we would call a transitory trade, and now we're betting that we're going to go further down, and that trade is working out great. Now, it is very difficult to put on a trade when you're in the midst of creating the volatility. I mean, that's a lot of people talk about that. When markets are falling like that, it's very difficult to catch the falling knife, and that's essentially what we were trying to do. So, however, this volatility, once you have that injection of volatility, it's something that is long-lasting, and it takes a little while for markets to recover from that. In the meantime, we should enjoy higher volatility over the coming days. And so this move down over the past 6 or 7 days, and we don't even know if we're done yet, but probably. This move over the past 6 or 7 days is going to have a lasting effect for us, where volatility will be elevated, and placing trades in that market will be much easier, because now we can create spreads that are much wider and much taller. In other words, much more range, much higher probability of profit, much more premium with lower risk. And because the expected move is larger, we can literally place those trades further from us if we can get the our directional attitude right. In other words, if we can guess direction. Sometimes we don't even have to be close on the direction. In other words, we could say, oh yeah, we're going to have a bullish day today, or we expect the market to move up, or there's a range of prices, an expected move of 40 points plus or minus. It could move up 40, it could move down 40, or it could move up 20 and down 20 at the same time, right? So we'll put our butterfly somewhere within reach of that expected range. And then as the day progresses, because we are trying to collect premium 3 times a week, with expiration happening 3 times a week, every Monday, Wednesday, and Friday, that pyramid will shrink down into the ocean. It will fall down below that zero line. If it starts very high, then we can get it in a position where we have lots of range, lots of premium, and then it will sink down and we'll collect a lot of premium. We do that 3 times a week. The higher we can start, the more premium that we can collect, and the higher probability that we'll have. Now, of course, when you get over a certain amount of volatility, we start getting into this sort of chaotic condition. It's kind of where we've exceeded the limits of entropy, I guess. And so that's why you have this kind of Goldilocks zone, in the same way that when it gets below and you have this anemic condition under 17 of the VIX, it makes it very difficult to put on a trade. When it gets above 34, and apparently 34 is about that number, 34, 35, somewhere around there, then volatility starts getting a little out of hand, and it's very difficult to then predict where price is actually going. So that's where we sit. There's our Goldilocks zone. The VIX 17 to 34. We are squarely within that range right now as I speak. Volatility is sitting at 27.8. 28. That is perfect. We love that. So anyways, there we go. There's your lesson on why volatility helps the zero-DTE trade. If you'd like to try out our strategy, go to zero-dte.com/try. All right, that's all I've got to say for today. Happy Monday. Mondays are always happy for us, and we'll see you on Wednesday. Take care. Oh, we have a question. The old videos of the zero DTE started with a in the money credit spread. Why switch to butterflies? Is it related to this volatility idea? Yeah, it actually goes back to an idea that I had a long time ago when weekly options first started with Apple. And I'd been working with this premium collection idea for a long time. And I found that the problem with credit spreads or spreads, in the money spreads, is that they provide you with too great of a risk to potential reward. And the strategy that we came up with totally flips that around. So prior to this, we were looking for something like, 2 parts risk to 1 part reward. That would be considered a good ratio for us. There was way too much, and sometimes it was even more than that. And what some people do is they go for 9 parts risk to 1 part reward. Particularly if they put on an iron condor, hoping to expand that area of profitability. But what it also does is it changes the whole risk to reward scenario. With this new scenario, this new methodology that we use, we've completely inverted the risk to reward equation while not giving up the probability of profit. So now, instead of being a 9-to-1 risk to reward, we're more like a 1-to-9 risk to reward without decreasing the probability of profit. So that's why. And this volatility idea, yes, you are in fact correct, helps us do that. So that's where we are at. Thank you for that question. All right, now it's time to go. Got to get back to work. We have a trade on, and it is making money, so we got to tend to it. Got to manage those profits because we don't manage risk. Managing risk is inherent in the strategy. All right. Thank you very much. Take care. Have a great day. Where is that off button? There it is. Peace to you all.